Welcome to Ivanoff Retirement Insights with Paul and Travis Ivanoff. The father and son team at Ivanoff Advisors has been helping clients grow and protect their wealth with a combined 50 years experience. Paul and Travis understand the importance of having tax-free, reliable income in retirement, protecting your assets, and helping you achieve your retirement dreams. Now, Ivanoff Retirement Insights.
Thanks for joining us for Ivanoff Retirement Insights as we take the big picture of retirement and take it bit by bit so we can get all up to speed on how things come together for your retirement plan. Of course, Travis Ivanoff and Paul Ivanoff are here today. Guys, how are you both doing?
Doing fine.
I'm doing great.
Yourself?
Thanks. How are you doing?
I'm doing very well. And look, I know that podcasts, they can last forever, so someone might be listening at any point in time of the year. But at the time of this recording, we are creeping towards the end of 2024, which is crazy to think about, but it does mean it's RMD time. I want to start super basic with this, though. What is an RMD?
Yeah, so an RMD, required minimal distribution, is what it actually stands for, is a percentage of your portfolio that needs to be taken if it is tax deferred, meaning you've never paid taxes on it before, so it's grown tax deferred for your entire life. And now, essentially, as you get older, between ages 73 to 75, you have to start taking a percentage of your portfolio based off your life expectancy and the value of your portfolio on December 31st. So it's going to be in the ballpark of between 3.7 to 4% as it changes. But that is something that your accountant and the companies you work with always help with. They'll usually send you a form letting you know what your RMD is. So essentially you got away with, never paying taxes on that money. And as you get older, Uncle Sam wants to make sure that you are paying those taxes.
So what are the penalties for not taking your RMD on time?
Well, as of 2024, they have changed it. In the past, it was a 50% penalty, but now they dropped that down to a 25% penalty, and it can be as low as 10% depending on the situation.
Wow, it sounds like that is a steep price to pay if you don't take these RMDs on time. So when you're working with people, do you make sure that their RMD strategy is up to code?
Absolutely. Yeah, what we're doing is we're sending email blasts. We are sending snail mail newsletters letting clients know, hey, it's that time. Let's get your RMDs going. You got to make sure you pull them out. The companies are sending letters on, hey, you need to pull your RMDs out. And it's always built into all of our strategies as far as, hey, this is your required minimal distribution. Our software is able to calculate it correctly for us. And we make sure that clients are pulling it because the last thing you want to do is have a penalty on money you're already going to have to pay taxes on anyway.
Is there a way to create a strategy around taking your RMD? Like your retirement savings have been in a tax-deferred account, but is there a way to kind of maneuver that so you could get it over to going ahead and paying the taxes?
Yeah, so, there's quite a few strategies there. So one might be simply as pulling out the money sooner. That way, even though it doesn't count as an RMD per se, but if you pull your money out prior to RMDs, you can start chipping away at that overall principal value. And depending on where taxes are in tax code, maybe you'll save on taxes because taxes might be lower right now than they will be in the future. And that's kind of the consensus right now. Usually taxes are going up. But again, I'm not a tax professional, but in our office, we have a couple different accountants that work remotely that help us with tax and RMD strategy. Another strategy that's popular for us is we might use a dividend style portfolio that is producing enough income to cover your RMDs while hopefully allowing the portfolio to grow and cover the RMDs at the same time. And then another thing that we talk a lot about, and we talked about in past podcasts, is the Roth conversions. Again, we bring in your accountant or our personal accountant to handle this because we're not tax professionals. But if you know your RMDs coming out and you're still in your early 60s or even mid 60s or at any age before, it might make sense to do Roth conversions to try to lower that RMD amount once you hit there. And Paul always kind of talks about this as well. But one thing we say is, do you want to be forever taxed on all of your money or never taxed on some of your money? And that's where Roth conversions come into play. So whether it's Roth conversion, dividend portfolios, or simply pulling the money out and spending it, the sooner you can start doing that. I tell clients, don't kick the can down the road because the reality is at age 73 and 75, you might slow down a bit. So why wait until you're forced to pull that money. Why not start utilizing it now while you're in your go-go years and you probably have a little more energy? So that's another conversation we have, go-go versus slow-go and no-go. Well, in your 70s, you might hit those slow-go years, and then all of a sudden you have an influx of cash because you're forced to pull your RMDs. So it might make more sense to start that sooner, consider Roth conversions, consider dividend strategies. So there's a couple different ideas there.
You definitely want to be proactive when it comes to this stuff. If you are interested in talking to Travis and Paul about your options for the future, you can reach out at ivanoffinsights.com. Now, I am curious, the messaging for retirement as we're saving, working through our careers is just save, save, save. Put it all in your 401k. Save, save, save. But the RMD concept, I'm not sure a lot of people are aware of this. How often does someone walk in and you mention RMDs and they're like, wait, what are those?
Yeah, very often. I think 80% of clients have maybe no idea about what their RMDs, or even those that don't really know how it works, how they're taxed on it. And it is a big deal because we run into clients that have, a couple $1 million in a tax deferred account, and maybe they have a great pension, they already are good on income, and then all of a sudden we're the bearer of bad news by, hey, do you know at 73 or 75 you're going to be forced to take a couple $100,000 a year? And they go, well, I don't even need the money. I'm like, well, we need to start planning now then. So a lot of people aren't aware of how it works. So that is a big conversation. And usually if I say RMD, I need to start there because they go, what's an RMD? So then I have to explain that as well.
Yeah, usually they don't have any idea about the terminology. They come in here and they say, well, don't I have to take taxes out at some point? And then we get into what an RMD. They say, what is that? And then when Travis gets into why kick the can down the road, let's start taking it out sooner, then they start realizing that, a lot of them have children that live in California, and it's hard to buy a home here. It's hard to make ends meet for a lot of their kids. So by not kicking the can down the road, they take that money out sooner. They can actually help their kids. They're going to be leaving them a legacy anyways, most likely. So let's start sooner, help the kids out, maybe help them with a down payment on our first home or help them with further education. So it is important to have a strategy.
I think there are just a lot of ins and outs to retirement that the average person doesn't realize. So if you want to get all your questions answered, if there are things you're wondering like, hey, do I need to take taxes out at some point? These are questions you can ask. Guys, what did we miss about RMDs? Is there anything else we need to know?
There is a rule that people should be aware of on required minimal distributions, and that is if your spouse is 10 years younger than you, they usually will lower the amount of money you have to pull. So that's something to be aware of. That not everyone catches. So that's something that needs to be brought to your accountant's attention and your financial advisor's attention to make sure you're not pulling more than you have to if there is a difference of age of over 10 years.
Thank you guys so much for clearing all of this up. I know RMDs, it can be one of the tricky parts of retirement, and clearly with all the penalties, it could be costly. So thank you for explaining, guys, and make sure to hit that subscribe button so you can catch the next episode of Ivanoff Retirement Insights to get more information on Travis and Paul and how you could work with the team yourself at ivanoffinsights.com. Thanks again.
Investment advisory services offered through Ivanoff Wealth Management, a registered investment advisor firm. Registration is not an endorsement by security regulators. By contacting us, you may be provided with information about insurance products, including annuities offered through Travis Ivanoff, California CRD number 325275. The firms are separate entities. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company and are not offered by Ivanoff Wealth Management Incorporated. Read your contract for restrictions, limitations, or penalties. Ivanoff Wealth Management is not licensed in all 50 states. To find out if Ivanoff Wealth Management is licensed in your state, please call 714-553-1490. Ivanoff Advisors is not affiliated with Ivanoff Wealth Management Incorporated. Advisory services are offered by Travis Ivanoff through Ivanoff Wealth Management. Insurance services are offered by Paul Ivanoff through Ivanoff Advisors. The aforementioned are unaffiliated companies.